Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, January 9th, 2026. It's 11:01 a.m. Eastern Time as I'm starting the video, so we're about an hour and a half into the trading day. And what I'm going to do in this one, start out with the equity markets as I often do. We'll look at the large and small caps, then a brief update on gold and silver, precious metals and miners. I'd like to do a very brief update on Treasury bonds, mainly to look at yields, although we also have a trade idea out there on TLT or ZB, the 30-year bond. Quick update on natural gas, the grains. I posted an update on the site recently on the one of the comments with my thoughts, so I'll hit on that. And those are wheat, soybean, and corn are your three main grains. OJ, for anybody still in that, that's another ag commodity futures trade. And then time permitting, if the video doesn't run too long, I'm going to just kind of breeze over everything. If so, I'll get to some individual stock trades that stand out right now. All righty, there's S&P 500. We're looking at a daily chart here. In a nutshell, we've been in a multi-month trading range. It goes all the way back to late August, early September right here. The S&P keeps punching at this high, trying to test it, making a marginal new high, but we've been diverging since this point here. We had that first shot across the bow. There's that key October 10th low that I've been harping on forever and a day that needs to go to open the door to a real correction, or real, significant drop, double digits plus, or double digits. I'm sorry, you can't have a double digit plus drop. And that's we're at the top of the range now. And so we're not at any risk of breaking that anytime soon. That's about 652.83, give or take. But you do have this uptrend line here, and we have a comparable uptrend line in the Nasdaq 100. I'm about to get to, except on the Nasdaq 100, we have also have a downtrend line. We have a symmetrical triangle pattern. So again, any new high anytime soon will be just simply an extension of this divergence. Does that guarantee that we can't go a lot higher? No, absolutely not. Anything's possible. We could blow off top. I don't think that's the most likely scenario. Again, I can, I'm not going to sit here and tell you the market's going to go up, could go up or down. Don't pay anybody for that. What I'm trying to say, I quantify everything in probabilities, and based on the technicals and many other factors I've covered, I suspect any new high, again, if it goes up 2-3%, will fail and will come back down. And what you want to look for is a solid move back down in the trading range. Right now, you want to look for a break of this uptrend line right here. Comes off that low from, what is that, right here, about October 20th, 21st, November, I'm sorry. And then that should, the MO in a trading range is when you get to the top of the range, you short, go to the bottom of the range. And then you go long, you go to the top of the range. There's also a midpoint you can trade off of. Once that midpoint, so these are your support levels, guys. That one right there, the uptrend line, then the 673.80 level. So if the uptrend line breaks, it's going to most likely bring us back to the midpoint of the range. And from my, again, from my analysis, I think whether we have a marginal new high or not, we're probably going to go back down to the bottom. And this range is getting very long in the tooth. So if you break that, again, you take out the key October 10th lows, which have already been tested successfully once. Been harping on those for months now. Then you have the 200s below. Now here's the thing. Traders, both man and machine, meaning algo programs, buy programs, humans, they like to buy the pullbacks and the bull trend of the 200-day moving averages. And, it'd be atypical to just go right through them like they're not there, right? Even if you briefly overshoot them, then you usually come back, test them, hold on them, or recover. But the thing about this is, keep in mind that and again, I'm talking 5 steps ahead, break there. If we break down below this trading range, and it happens anytime soon, that these trading ranges, I often say, act like energy building, like a coiled spring. So when you finally get a definitive break, a break that sticks in one direction or the other, it's usually a pretty powerful move. I talked about that back here. The exact same thing happened here. We had a failed breakout to new highs, as I predicted it would fail. Went down. Then when you broke below the range, that was it. It's all she wrote. Took us right down through the 200s. And as I said, they came back to backtest the 200s right there, these two blue and red lines. And when it failed, we cratered right there. And so keep in mind that the 200s, just like back then, almost identical technical posture to back here, this trading range, the 200s are in very close proximity. So therefore, if we get that energy, if the downside break does occur, there's a good chance that at most these will probably get tested, maybe back tested, and we're going to go considerably lower. Again, that is 5 steps ahead. Step 1, step 2 right here, right? Step 3, a lot of steps before we even get there. I'm just kind of throwing out longer term stuff so you can help formulate a trading plan. If even if you're bullish and you think we're going to go higher and break out, be prepared. And if you're bearish and you think that's going to happen, be prepared if we do break out. And one thing you could look for example, if we break to the upside, a solid break, is maybe a back test of this. So maybe you're bullish, you want to, you don't want to buy the breakout, or you might want to buy part of it. Maybe you can get a back test to the range or a back test to the midpoint or something like that. So that is not my preferred scenario, but again, it's certainly in the realm of possibilities, just lower probabilities in my opinion. So moving on to QQQ, daily chart. There's your trading range right here. Again, multi-month trading range going back to last year, early September, late August. And unlike the S&P 500, which is made or is flirting with new highs, we're still off the highs from October in the market-leading NASDAQ 100 with all the high-weighted FANG stocks, overweighting it. There's your symmetrical triangle pattern. We are currently testing the top of that triangle pattern. A breakout to the upside, again, unless it fails, can be construed as nothing but bullish. If we do, the levels to watch then, traders will watch these previous reaction highs. You've got one right here, and then one right here. If you break that, it's going to increase the odds that you're going to run at and maybe pop those highs. I can tell you probably if you break it and start moving up, there's a decent chance you'll put in a marginal new high. And again, doesn't guarantee anything. In other words, it doesn't guarantee it's going to fail, but I can guarantee that if it happens soon, it will be a divergent high, just like this same one back here, right? Same prediction at that time in the trading range, a little pop there that failed, then the range was taken out. And again, just like the S&P, the 200s were taken out here, back tested there and rejected. And so again, the catalyst, the technical catalyst was the downside break from that trading range that set up that whole short trade there, although we had shorted up in there earlier based on, just like now. Let me drop down to the 60s. So again, we're at the top of the triangle pattern, which in itself, you can make a case for a objective short entry add-on. If you're bullish, you can make a case if it's a solid break, that especially a daily close above it, you might want to go long or add to long exposure. However, we have on the 60-minute chart, my go-to swing trading time frame, watch, rinse, repeat. I like to see these divergent highs and divergent lows to swing trade long and short. And as I pointed out, we recently broke these uptrend lines, these minor uptrend lines, following the most recent divergent highs on both QQQ that you're looking at here and SPY, which I'll get to in a second on the 60. All I can tell you definitively, I cannot tell you with certainty or the highest degree of confidence that this we're going to continue lower, but I can tell you with a fair degree of confidence and certainty. And I believe this is an objective place to initiate or add to short positions. In other words, if you didn't take the short the other day right here, it was good for about a 1.5 or 1.25%, I think, percent drop to my first target. I haven't changed these levels. 618.38 was the first one I gave you on the chart the other day. All these levels are the same. They're all potential targets. So therefore, whether you took it and covered there and gave the bounce, doesn't matter. If you missed it, this is an objective short entry. Okay, because it's resistance. Why is it resistance? Reaction high there, reaction high there, reaction high there, reaction high there, a bunch of gaps around that area. And so this is a resistance zone I've had, and we're at it right now. So that's it, hard stop. Objective short entry, it either works out or it doesn't. What if it doesn't? Where's your stop? Well, that depends on you. What are you targeting? Are you just looking for a quick pullback trade? Typically corrections work in at least an ABC, three-wave pattern. So that would take us down maybe to the next target there. If that's all you're looking for, you want a relatively tight stop, right? And if you're looking for the prize, going back to T2 on the daily chart, which is still an active swing trade, we need to take this level out. But again, we'd see us break here, break that trend line, the uptrend line, break this 614 support. That would take us down to the bottom of the range, 589. If we got there, it's going to increase the odds. Again, this range is getting long in the tooth that we're going to break down. So therefore, to quantify it, if you're going for T2 on this trade, let's just say hypothetically that you covered on T1. You took this short that we made here, here, here. We had multiple entry points, and you gained that bounce off T1. So you covered your short, turned around, gained a bounce to profit on the long, and now you want to go reposition for a swing short down to T2. That's going to give you a drop of about 10.5% from where we're at right now, which is about where we shorted it the other day, or where I give you the sell signal. Therefore, you can use easily a 3-4% stop loss and give yourself a nice, you could give yourself a 5% stop loss. That's a decent 2-to-1. I usually use at least a 2-to-1 or better RR. Again, it depends on the trade. All right, so there's your update there. Let's look at the futures real quick. Before I leave that, I told you I'd give you the SPY 60. There it is. So SPY, S&P 500, divergent high, correction. Divergent high, again, sell signal there with a break, drop, correction. Divergent high here, and it's all been building this whole time. We've been building these divergences. And so what tends to happen after these smaller divergences build and you get these little pre-tremors or whatever you want to call them, then the bigger drop comes. You can see the potential targets here, and that's about the bottom. That is the bottom of the trading range there on SPY. So if you're doing that simple trading strategy of recognizing a trading range, shorting the top, your goal is to cover the bottom, then that's it, and you could do that. Otherwise, again, this guy's getting long in the tooth, and it's going to break one way or the other. My guess, if we get to the bottom of the range again, if we do, then we're probably going to break it. And if we do, it's going to be a lot of energy, and we're probably going to go through the 200s. But if we just break up and keep going, then we'll have to see later on if these levels are still going to be significant. If we get too far away from them, they may not be. All right, futures for futures traders. I'm going to cover a lot of futures charts in here, especially commodities. That's my preferred vehicle, usually in trading. Let's see, what's this? NQ. This is the NQ NASDAQ 100 futures. These are daily candlesticks here. There's 18 months of trading history, and there's that same triangle pattern that I showed you there, right? And so, again, bullish, any breakout unless it fails. Bullish, take out the previous reaction highs. But again, any new high anytime soon, meaning over the next few weeks, will still be, because these indicators are lagging a divergent high. Any break below that trend line is going to be the next sell signal or objective add-on or new short entry, and that would be your first target there, about 24,373. Next stop, 23,246. That would be a total of about 5.5 to that first target, and down there is about 10.4, 10.5% from where we're at right now. Yes, I can give you other time frames if you want. Oh, that's natural gas. NQ, what do I have for you here? There's my what's this? No, that's NG. Okay, 1 second, guys. You know what? I want to move on because I'm spending a lot of time on the indexes. Didn't want to spend that much time because there's not a lot of new developments, but I want to cover the small caps. I often tend to forget to get to those. So from a very short-term perspective, this is a daily chart. This is your uptrend line for the next sell signal. This was a divergent high. We hit almost hit T2, came really close to hitting T2. We hit our first target there off the breakdown and back test there. And I'm just going to borrow you and put you there, and I'm going to borrow you again. So basically, it's a series. They're all the same negative divergences that have been building for months now, many months right there, about, I don't know, 5-6 months. And so that's it. So DH1, correction 1. DH2, correction 2. DH3, sell signal to come there. Stops are always just a suggestion based on a specific entry point at the time. A lot of these trades have multiple entry points. So that one is done. We already, I think we closed the week above there. However, I still like this one. So again, whether you're in it or not, I can just tell you the next sell signal, an objective short entry comes there. I can tell you these divergences continue to build, and I can tell you I have the highest degree of confidence that this breakout, the new highs, will fail based on the technicals and fundamentals. I still told you I'd do a video on fundamentals. I'm not in a rush to do it because it's not a, there's no exact timing indicator. I will get to that within the next week or so when I get the time. I just want to put together the right charts to show you and make it not too long and runny. Just kind of hit some of the most important ones. I'll try to keep it, relatively, I say relatively short if I'm covering the economic, the key economic indicators. We're talking at least a 30-minute video. And remember, guys, you can always play. I do it on YouTube videos all the time. Increase the speed to 1.25, 1.5, 1.75, whatever you can handle. Gets you through the videos a lot quicker. All right, so that's it. So basically what I'm looking for too from long term, this is IWM. This is a breakout to new highs, and that is bullish on face value. I'm going to repeat that. That is bullish on face value. Any new breakout to all-time highs, because at that point you have no remorseful holders of the security when something breaks out to new highs. Everybody's positive or profitable. However, as I often say, fewer things in trading are more bearish than a failed breakout. So that's what you want to look for. Breakout that fails, then the next stop, if it takes out 231-ish right there, and so forth and so on. Based on the weekly charts, again, I have a, look clear to me, high degree of confidence. You can see every one of these divergent highs have been pointed out in the past. Divergent high, divergent high, divergent high, and you can just look and see what happened after. These are all double-digit drops. So I really, honest to God, struggle to see why this time would be any different. Will I be shocked and floored if it doesn't? No, because I've seen divergences play out. It's rare. It doesn't happen often where they're burned. I'm sorry, where divergences get burned through, I meant to say, not play out. If it plays out, we go down. And you know my targets. All right, so let's move away from that. Let's get to the other stuff now. Not a lot to update in gold, silver. I'm going to go to the futures. Okay, gold continues to walk up that uptrend line. As I mentioned around the holidays, I think that was New Year's Eve right there. If I said it once, I probably said it 24 times between Thanksgiving and Christmas. Take any breakouts, breakdowns with a big giant lump of salt, because that's when you get that virtually, the volume just dries up. Everybody's on vacation. It leads to whipsaws, whether or not it's because of low volume and the big trading desks have enough money to move. If anybody has enough money, they can move a stock. That's why penny stocks are so heavily manipulated. It's easy pump and dump schemes. A little bit of buying, a little bit of money thrown at them on the buy side runs them way up. And then when the bids collapse and there's not any more buyers, or a lot of selling, they can just crater down. And so what happens is the same thing can happen on other securities if you get enough buying and selling. Now, whether that was intentional or just due to the holiday doldrums, but I've highlighted at the time that it broke down. You can take it on face value, but you should still take it with a grain of salt. And so either way, we were as quick as we went under, we went back above. So it's a very, very well-defined trend line. And so the last time I updated, we were right there. We were testing it. So what that is, another reaction. What did I mean by that? It basically just further validates that trend line as a key level. If I was noticing it back here, everybody and their brother's got to be looking at this trend line on gold now. So I can assure you, when it's finally taken out with conviction, it's going to be a significant technical event. Doesn't guarantee you can't have another whipsaw, but traders are back in swing now. So the next solid breakdown should do the trick and get you down to those targets I've given you. So unless that happens, again, anything that happens at silver and GDX doesn't matter, because this is the one that they follow. So that's your update on gold. You can look at it on GLD, but remember, the futures trade around the clock. They're more accurate. GLT is an ETF. It does as good a job as you can for an ETF to track the price of gold. We still have the divergent high island cluster top. And that's it. Oh, I'm going to show you silver futures too. Silver futures put in about an equal high after putting in that. They went parabolic. Remember, I don't have a parabolic line tool on this chart. That's a parabolic uptrend. Potential blow off top, high and climax. And then they made about an equal high right there, or marginal new. Doesn't matter if it's equal or slightly higher, as long as the indicators are diverging, which they were from this point. So what you didn't have here, you did have all the makings, what looks like a blow off top, but you didn't have a divergent high. You don't have to, it just helps. You could probably draw another trend line now that we had those the New Year's whipsaws. Yeah, I'm going to add that trend line right now. That's going to align better with the one in gold too. So there's your new uptrend line, because we just bounced off that one right there in gold as well. So have a price alert under that. Again, if you short silver GDX when gold breaks, I'm sorry, without gold breaking, well, what happened the other day is actually a good example. Gold hit the trend line and bounced, and so these guys bounced with it. Um, thing about this whole thing right here, it's atypical. From my experience, when you have a parabolic top, as we clearly did, a parabolic advance, I should say, only hindsight will tell if it was a blow off top. It is atypical to come back in and retest it, but I have seen it, and I had an example. I should have queued it up for you. It was, I think it was Cisco, was it? Oracle, Cisco, one of those guys back, and a lot of them, if you look at the tech stocks back in 1999, heading into the 2000 highs when they peaked, they went parabolic, and some of those actually made, after putting in a parabolic advance in the first leg down, they all made, a lot of them made marginal new highs. So again, it is possible. I said atypical, that's all. It doesn't happen often that you see another advance that matches that. But that's your update there. And again, watch gold, watch GC, gold futures. Even if you don't trade it, you want to see the trend lines on both GLD and gold futures get taken out. All right, natural gas. Let's do that one. That's it. Watch, rinse, repeat. Look for these divergent lows. Came the bounces. Watch out for the divergent highs. That's usually the end. That's swing trading 101. These are all your divergent highs. As came after it. These are all your divergent lows. That was a divergent low right there. And again, watch, rinse, repeat, right? This is a swing trading vehicle. Like the markets, it's kind of going nowhere, but within a big range. So it's been a trader's vehicle, not a buy and hold yet. I do still think the potentials, and just like wheat and corn and soybeans, I think the charts indicate they're at pounding out probably a significant bottom and setting up for a nice longer term trend trade that will last months, possibly even years. But until we start taking out the higher end of that range, this is what we have to deal with. So there was our last long entry. I highlighted right there on the support level. We hit my first target. I forget what it was, 9-10% gain. Went a hair higher, came back down, and so all that's happened, and we're now back at support. So I can say this with the same degree of confidence I said what I told you the other day here. Natural gas offers an objective long entry here at support with positive divergence. Hard stop. That's it. Take it, don't take it. It has a history of sometimes every now and then blowing out the stops by taking a little stop raid down below support, which is always bullish if you recovered. So even if you get clipped out on your stop, you want to keep stops tight on the Widowmaker, that's fine. But if you see recovery back above, especially if these divergences are still intact, you may want to jump back in. Otherwise, like I said, and again, your stop is going to be commensurate or relative to your price target or targets. Everybody's different. Some people like to get that quick 10%, get out, wash, rinse, repeat, do it again, do it again, do it again. Others want to hold out for the prize, the 20, 30, 40, 50, 100% plus runs in natural gas. So there's your update there. The commodities, or the ag commodities. This is ZW wheat. In the essence of time, I'm just sticking with the futures charts now. They are the real deal, by the way. You're going to always have tracking performance decay, other cost issues when you're looking at the ETNs or ETFs, like WEAT, CORN, SOYB for corn, wheat, and soybeans, or wheat, corn, and soybeans. But upon request, I always give you those charts. I'm just going to cover these now. So this was our last divergent low right there. There was your breakout buy signal. Wheat, just like natural gas, has been pounding out this bottom on the longer term charts at long-term support for a while, and we keep getting these runs up. They're nice swing trades, and that's all they are. They turn out as soon as the first divergent high is put in. That was DH1 right there, by the way. And you had a first correction. You actually put in a divergent low, had another rally, divergent high, and now this is the most recent divergent low. You can find these charts. Somebody asked, and I put the charts of at least wheat, I think corn, wheat, and soybeans. I like them all. in the one of the comment sections under the recent post. What I can tell you right now is we are back testing this trend line. I'm not super crazy about it because I usually like to come off the highs and it doesn't well, you could do that. You could certainly put that one there, and a little bit lower would still be a back test. So there's my first target zone, second, third target right there. All right, let's do corn and soybeans. You know what? Here, let me just give you the, because I know I get a question a lot of ETF traders. This is, and remember, this is corn. The futures look even better. But this is was a divergent low there. We hit my we had actually I started highlighting on this divergent low. I gave you 6 targets. I still very much maintain. Re-highlight it there. Divergent low. We hit T1 again. So that's the level the ETN CORN that needs to take out to open the door to all my targets up there. And I view this as a likely basing, bottoming range there. And you can see we have a primary downtrend line right there. So if we can pop that, 1882, then T1 again, and then these longer term targets. Why do I think this is just high level consolidation? I've made the case many times that just about all commodities, most of them, including the grains, bottomed when COVID hit, and we've entered a new, in my opinion, a new bull markets in commodities, including corn. That was a bear market from the 2012 highs, and this is leg one up, I believe, in a new bull market. We put in a divergent high. We were long off those lows, carried it there, came back in. This is a divergent low. This is a weekly chart, positive divergence. We just need to take that trend line, and it should, in my opinion, start the next leg up. That's why I'm, keep talking about the potential for any one of these little 60-minute divergent lows that so far just turn out to be quick swing trades, 5, 10, 15%, whatever they are, has a potential, especially now that we're testing that trend line. One of these is sooner or later going to pop that and take us up. You can see my targets here. And then soybeans, SOYB, or ZS if you trade futures. And again, corn and soybeans, they clearly bottomed already, and they've been moving up. And now we're at trend line support on this weekly chart of SOYB. That is not my line tool, but this is. And so there it is. Boom, boom, boom. Go down to daily. Here's that same uptrend line. And again, these are long-term trades as well as swing trades. Divergent low, we hit T1, we hit T1 again, we hit T1, and then when we took it out, I mentioned that and said that would open the door to T2. The next targets, we hit T3. And we pulled back to support. So I can't guarantee the support will hold, but I can guarantee you it's a valid trend line, and I can guarantee you I believe this is an objective entry for the next, and we've already hit up to T3 now, so it should increase the odds we're going to go up to these higher targets, but of course we're going to need to take that one out first. Could probably even give you a little trend line there, downtrend line, I'm not sure. I don't want to force that. All right, let me move on. Either way, there's soybeans. OJ, for those of you that took it or are still in it, this one, as I mentioned at the time when I gave you the trade, does not have, to the best of my knowledge, an ETF or ETN that tracks it. You have to trade futures. That's the only thing option to trade orange juice directly. And again, if I'm wrong, if somebody knows of one, if a new one came out, let me know. But I've been doing this for a while. I will point out there's a potential divergent high right here. We could probably give you a trend line too. So if you're in it, we took this. Now, when I first gave it to you, it was the previous contract. I think these are every 3 months. Unlike some futures like natural gas, you can roll every month, have futures that each month. Some are quarterly, and just like the indexes, NQ and ES. Oh gosh, I think we took it there. I think it was, what was it, 20-30% profit. We hit T2, and that was the last update. No, 50%. So we had 50%, blew the market away. But again, it's one of many trades. You're going to win some, lose some. And I want to say we took out, and it's played out really nicely for those of you that took it. Oops. Well. All right, I'm going to have to put that line back. It was right there. Oh, no, I have an undo feature. Let's do that. 1 second. Bear with me. Where'd it go? Edit. Oh, yeah, right here. That's better. Okay. All right. So, look how well the technicals played out on this. Remember, I had to replicate the levels. When I roll futures, Some futures, especially like this, you're talking 3 month differential in futures, you're going to have the price levels change. But the way I replicate a chart, I look at the reactions that I place those levels at. So they're the same targets, but the price values are going to change, and especially on things like natural gas that are very volatile. Anywho, so we made 50%, and you can see we hit my first target there. Then we hit T2, 50% gain. There was a beautiful objective reentry back at T1 because that was support, right? Support once broken, resistance once broken becomes support. And now we overshot T2 and we pulled back to it. So you could make a case, and we're at uptrend line support to go along here. Yes, there's negative divergence. However, as I often say, divergence is not a sell signal. It's an indication that we may get a trend change, especially if you get a sell signal, which would be a drop below the trend line and that T2 level. However, sometimes when you put a big divergent low, you can burn through these little divergent highs on the way up. So these are still the targets. And if anyone's in it, I haven't heard a lot. I didn't see a lot of comments on the last update, so I'm not going to spend any more time there. But if anybody wants updates on this or any other trade at any time, just let me know. Bump me in the comments section. There's a few comments I haven't gotten back to since yesterday. I'll try to get to those later today. Wow, we're doing good on time. I don't know if I paused the video and recorded over, missed recording over part of it, but I'm going to go over a few individual trade ideas. I'll start out again. I highlighted these the other day. Thank you, Jay McCallum, for mentioning a lot of these, boring, underperforming, look like they're in death spirals, but blue chip companies. And so they still look good. And a couple of them, again, I highlighted that in the recent video I gave you. Where are they? Where's all my... That's very weird. I know I replied to all these. We'll do. I must have posted those charts under another post. That's it. Yeah, I know I posted all 4 charts. And so go in, and maybe it was on the following day. Maybe I missed that. And check those out. And I covered them in a video too. I have added some targets for MDLE. This one I said was actionable at the time. That's what I was looking for here. And MDLZ. This one on that chart. Oh, here it is. This is I posted on the 6th, January 6th, a few days ago. And so right here was at support. Nice support. And so there were a couple others that had a little more downside that they hit comparable long-term support, but this one offered an objective long entry. And wanted to give you, I've added some price targets to it. That was on the weekly charts. That was right there. And this is where we're at on the daily chart now. So it hit this 5150 level. These are now the targets. So you can see I have a potential downtrend line. There's a couple of reactions, but nice price resistance levels. And again, I think this one, I'm just going to take this across. This is the divergence has only gotten larger. And that is a divergent low right there. We've actually been diverging since this point right here. We had a little divergent low, got a nice rally, probably double digit. Yeah, that was 8%, close to it. And now much bigger divergent low. So again, I really like these guys. This market is getting frothy. Worst case, again, I can't make any promises, but these are the kind of companies that don't go to zero. They're not usually going to have bankruptcy filings or any surprises. They're just out of favor right now because everyone wants the high growth stuff. And I promise you, when that trade reverses, it can reverse very fast. And so, again, I think these are worth scaling into or taking those levels on the charts that I gave you as buy points. This one already hit that buy point. Not exactly, it's not a U.S. company, but it's still kind of a blue chipish company. It's Danish, NVO, still one of my favorites. Somebody asked about the other day. Nothing's changed. We hit the 4 and almost hit T5. And we got there. I started telling you at that time that I wouldn't be surprised and was leaning towards it, making a retesting the lows. And it gave us exactly what I wanted, a marginal new and divergent low, followed by a little even better, a one-day whipsaw, false break of that previous low, which is a bear trap. And so, again, this is still one of my favorite positions. It's my largest, but that's only because my wife works for the company. That's a 401k, so it's the only stock option we have in there. And this has just been, like I said, a great bottoming play, positive divergence. Stock was down, again, one of the uh, recently. Recently, before it was the first trade idea, first thrown out to you here, it was the largest publicly traded company in all of Europe. And of course, that was the kiss of death when that headline came out. But the technicals said it was going to go down. You could see clearly big divergent high. But I wanted to point out, I gave that to you as both a swing trade with these typical swing trade targets here and a long-term trade, which is still very much in play. That was right here, long-term support. Again, we had that nice undercut that gave us the divergent low on the weekly, which makes it all the better. Big positive divergence. And we quickly hit my first weekly target right there, the downtrend line and that price resistance level. And I wanted to point out that we're testing that again. The fact that we already hit it once doesn't guarantee we're going to take it out, but it gives me what I call a check mark, meaning we already hit my first target, which opens the door, increases the odds that sooner than later, now we can keep hitting it, but once we take it out, it should open the door to T2, and that's the level I gave you back then when I first threw this trade idea out there. So that still gives this one, it's been moving up nice, but again, it's a bottoming play. Another 21% upside unless T2 is hit. And I may extend targets if the market's holding up in this stock. All right, so that's and it had a selling climax. Everything, a lot to like about that one. What else do I have for you? We'll wrap this one up. I'm at the 36-minute mark now. I still gave you 2 new trade ideas yesterday. SanDisk is still where it's at, I think. Sienna, I'll check in a second. Sienna following through so far on the breakdown, and the reason I'm updating it, because now that bearish engulfing candle yesterday is solidified or confirmed with a close, and it wiped out bearish engulfing candle, for those of you not familiar, and I encourage you to look these terms up, the body, which means the fat part, not the skinny parts, just the fat part, has to engulf the body of at least the previous candle. The more it engulfs, the more bearish it is. So in this case, you engulf 1, 2, 3, 4, 5, 6, and the body of is what you need to engulf. So really, you go back to here, all of these candles have been engulfed. So that means everybody that bought in these areas here, they're all underwater right now. And that's what makes that a bearish technical event. And there's no guarantees. God knows we've seen enough bearish engulfings. That wouldn't count as one because they have to come at the highs. So this is the first one I've seen in this stock since, I can roll back on the daily chart. I don't even know if we have one in Sienna. Either way. And then what was the other one I told you? SNDK. Not a lot of trading history. Started trading here February. Bearish engulfing yesterday. If we can close today at or below the high of that body right there, that candlestick, should still be looking good, but really needs to take out the recent lows. When you look at really on a 5-minute chart, I think that previous low would need to take out. Either way, there's your setup. It's got a divergent high. If I had a better trend line, I'd put one here. You could probably say that little trend line right there should do the trick. But again, you get the NASDAQ rallying today, so a lot of tech stocks are up. The fact that the Sienna's down speaks to that it's going against the grain. What I mean by that is inflows. Anytime, well, actually, I take that back. We're not really up, are we? We were earlier. Yeah, we flirted around today. The NASDAQ 100 opened up positive, went negative, and is positive at the moment, but basically, again, flattening out. It's been going nowhere lately. Okay, guys, I'm going to wrap up here. Oh, no. I told you I'd give you treasuries. TLT, I gave it to you on ZB and TLT. I give you that as an official trade idea with 1, 2, 3, 4 targets. We went long. Where did we go long? We've had a lot of trades on this. We shorted it here. We hit all 4 of my targets, 1, 2, 3, 4. Then we turned around, reversed this, covered it, on T4. T4 was the final target. And then I gave it to you as a long, I think right here on this divergent low, positive divergence, and at support. That's nice support. Look at all this. Look at that big old gap right there. A lot of reaction highs. And that's held. I'm not crazy about this one, but again, it's until support is support until it's broken, positive divergence. And we've been able to, thread the needle on TLT for gosh, for a long time now, really over historically. If you go back and look at all the trades on the site, I think that probably close to that 80% or so track record that I've been running lately. And it might even be north of 80%. Either way, just put more money into it because it's a low beta, low beta meaning doesn't move up and down as much as a stock market. But the more important thing to me really right now is yields. So when I look at the long bond, this is TYX, the 30-year bond. This is a daily chart. We've broken out above this downtrend line. Now keep in mind, this contradicts this what I'm telling you here with the trade. That would have to fail. Yields go down, the price of bonds go up. But we've broken out, we're back testing. It's not a super duper trend line, but it is a downtrend line. And this is very important, I think, the yields. And what I've talked about, the Fed losing control. This is where the Fed started losing control. This was their previous rate cutting cycle, 3 back-to-back rate cuts starting out with a big 50 base point cuts. And instead of long-term rates going down like they expected and usually do, they went nowhere but up. And this time around, the Fed started right here. They went up, back down a little bit, but then they've been climbing and they're up above where the rate cut cycle started, even though we've had 3 back-to-back rate cuts now. And so this, again, macro kind of longer term stuff and incremental. If and as we go up, and then this is the let loose level. If the yields break that level, we're going to bust out to, as I've mentioned, not a multi-year, not a 52-week high, but not even just a multi-year high, multi-decade highs in yields on the long bond. And I promise you, unless I will eat my shoe if the stock market doesn't freak out if the long bond breaks out to multi-decade highs. So watch it. We're not at risk of doing it right now, but from the near term, we have been moving up. And so if that TLT ZB trade doesn't pan out, starts going down, yields are going up, that's something to watch. Market puts a lot of weighting on the 10-year bond too. So I'm watching the 10-year yield, as I've been talking about, highlighting this trading range we've been in, and we keep pushing the top of it. Again, on the trading range, it's simple. You can short the top of the range, swing it down, meaning if yields, you can't short yields, you short the bond, the 10-year bond. I'm sorry, take that back. If you bet that the 10-year yield's going to drop, you want to go long the 10-year Treasury bond. And that is ZN for futures or IEF for the ETF. However, I'm more concerned really if it breaks out, then that should be a net negative or a net headwind for the stock market. And it's a pretty well-defined range, guys. So we're coming off a divergent low. We had a breakout there. And these are the things I put a higher weighting on really what's going to happen to the stock market. Now, if yields go down and they go down from organic market forces, meaning not a flight to safety bid because the stock market's getting hit, then that is net bullish. It just means interest rates or the cost of capital is going down. So this is what you want to watch for. All right, let's end it there. I can go over the rest of them, but that's not worth it. I'm watching junk bonds, credit spreads. They're not really red flagging or anything right now. Business, the BDCs still are showing, at least a yellow flag, but I'll cover those. I'll update those in another video. Let's wrap this one up here. This has been Randy Finney with Right Side of the Chart. Have a great day.